Today's episode is sponsored by Tegas. Understanding expert insights is table stakes for investors, and there's no better option than Tegas. I've been using them for almost 2 years to get up to speed on companies, and they've helped me immensely as an investor. Tegas also recently acquired BAM SEC, which adds a super fast way to access SEC filings and earnings calls and to incorporate financial data into my models. I run a monthly deep dive series sponsored by Tegas on the blogs. I'll include a link to my cable deep dive in the show notes, and I'd encourage you to follow the link if you're interested in how expert interviews can help you learn more about a company. Currently, anyone who signs up for Tegas gets free access to BAM SEC as well, so check it out. All right, hello, and welcome to yet another Value Podcast. I'm your host, Andrew Walker. If you like the podcast, it'd mean a lot to me if you could rate, subscribe, review it on wherever you're listening, watching, whatever. But with me today, I'm happy to have Evan Tindell back on the podcast for the second time. Evan, how's it going?
I'm doing well. Yeah, what's the record for most number of times someone's been on the podcast?
Oh, Jeremy Raper has it locked up at, I think he's at 6, but if you want to, you're a sharp guy. If you want to try and catch up to Jeremy Raper, I'm willing if you are.
That seems like a lot of work. That's a long road to get there, but I'll do my best.
And Jeremy's a prideful guy, man. If he knows people are coming for him, he's probably going to try and up his appearances. We'll just keep one up each other. Let me start this podcast the way I do every podcast. First, a disclaimer to remind everyone, nothing on this podcast is investing advice. We're going to talk about a really interesting, really hairy situation today, but everybody should just remember, I'm not a lawyer. I know Evan's a former professional poker player, but I'm guessing he's not a lawyer either.
Not a lawyer.
We're probably going to be talking about a little bit of law terms. So just remember, 2 non-lawyers telling you law terms, not investing advice. Please do your own work. Second, a pitch for you, my guest. People can go listen to the first podcast for the full pitch, but you're a super sharp guy. You've got an eye for looking at these situations with skewed upside, downside, and swinging. And I think that's what we've got here. So all of that out the way, I'm going to turn it over to you. The stock we're going to talk about is Twitter. I'm sure everyone's heard of it and knows what's going on, but I'll turn it over to you. What's going on with Twitter, and give us a full situation overview.
Well, yeah, just for some background, Twitter is a social media company. It was founded at yeah, I think everyone knows the story here. And just as far as the disclaimer, someone noted that the last idea I pitched on here is down like 40%. Which was 10-cent music. Someone lobbed that in on Twitter. Someone dropped that bomb right after your tweet.
Down 40 is the new up 20 in these markets.
So buyer beware. But yeah, I mean, Twitter is an interesting situation because I think a lot of people are confused, including apparently the market, about what's going on. I mean, you have Elon Musk, in case people don't know who Elon is. Offered to, not just offered, but has a signed agreement to buy the company for $54, and of course the 20 cents on the end. And he's been making a bunch of rumblings about trying to basically back out of the deal. And now the stock's trading for, what is it this morning, 37 something. And so I think it's pretty large. I mean, in the merger arb world, a 40% return to the deal price is obviously gigantic, and usually it implies that there's some, I mean, I don't know what your experience in this is, but it implies like there's some obvious regulatory or antitrust issue, or there is like some credible reason for the buyer to back out, although as we'll talk about, that's almost never the case.
So a great example would be right now, Activision Blizzard has a contract with Microsoft to sell themselves for, I think it's $95 per share. And that is no one doubts if regulatory clearance comes and everything, Microsoft, they can take the interest on the cash in their piggy bank and pay for Activision deal. It's a huge deal, but nobody doubts their ability to close if they can close. Nobody doubts that they want to close, but that's trading at about 77. So a huge spread, because people are looking at that and saying the regulatory environment is not great for big tech buying something else. So people price it at 77 because they say, hey, basically a coin flip if this goes through. If upside to 95, downside to 60, and we can debate downside, but they're pricing it a coin flip. With Twitter, $37, the deal price is $54.20. So it's an even bigger upside, and that's because people are doubting, hey, can and will this deal close?
Right. And the reason that he's given, to the extent you would even really call it a reason, is because of what he's claiming are material misrepresentations in Twitter's financial statements. And the specific thing that he's claiming is that the percentage of bots and that they claim in their financial statements as less than 5% of daily monetizable, that's the right word.
MDAU, monetizable daily active users.
Monetizable daily active users is less than 5%. And Elon thinks it's, you know, some much higher number. And I mean, there's a number of ways we could attack how we want to talk about this. I mean, the first thing is that he barely pays lip service to the actual definition of what they're talking about. Like, yep. Twitter, because what matters to Twitter is the percentage of their users that they can actually serve with ads, right? Which is why it's monetizable daily active users. It's not like if there's some spam bot that's just accessing the ability to post via an API, it doesn't really, and they're not like refreshing their feed and like looking at it like a physical person would. They're not getting served ads, and advertisers presumably aren't being charged for any ads. So they're not monetizable. Therefore, they don't go into the daily active users counts, and therefore the ways that Elon has proposed, like I don't know if I'm not sure if he even thinks this is a serious thing. There's no way that he can, but he proposed counting the first 100 followers, like, oh, hey, everyone count your first 100 followers. And if more than 5% looks like bots, then I guess is you just making up these like nonsense ways to count it. Like, I don't know.
I'm with you. It was absolutely crazy because again, Elon is a master, like kind of salesman, attention grabber and everything. And so when he says, go look at your followers and tell me if more than 5% are bots, and you'll see, it sounds great, but Twitter has been very clear. They're not saying that 5% of the users, the actual handle on Twitter, are bots. What they're saying is when we give you a monetizable daily active user count, that number, about 5% of them are bots, because they know that, you know, if they've got 500 kajillion people on the platform, they probably know that 4.9 kajillion of them are bots, and they don't include any of them. So Elon's doing this really great sleight of hand with a lot of the things that he's saying, where he's saying, oh, count your bots. That's not what Twitter was claiming, but we can talk more about the bots in a second. I just want to pause here. So I think we've laid out the situation. Twitter's got a contract at 54.20. The stock's at 37. If it goes through, you and I are very happy because, full disclosure, we both own shares. If it doesn't go through, you and I are both very sad. But let me pause here and ask the first question I do everything. This is a $45 billion merger. I think it might be the most watched merger and company of all time, right? $45 billion merger. Front page of CNN has Elon Musk news every day, all this. Every merger arbitrage in the world at least knows about this story. So when I talk about something with this many eyeballs on it, you know, the market's clearly pricing in some low odds of this still going through. Where are you and I divergent from the market? What are we seeing that the market's missing that results in a, it's not guaranteed to happen, obviously, but results in a risk-adjusted alpha opportunity for us?
Yeah, I mean, I think there's a number of reasons why people might be getting this wrong. I mean, obviously, one thing, and I don't know. I'd be interested to hear how you feel about this. One thing with any like really large merger is if there is like, and maybe Activision could be an example of this as well, just like the physical, like just the amount of dollars that you need to arbitrage a deal of this size, 40, 50 billion, 75, 80 billion is just a lot larger than some smaller deal. So I think to the extent there is a something to be arbitraged, it just has the potential to get a little bit bigger just because of the absolute dollar value. And no merger arb fund is going to have more than 5 or 10% in something like this.
This is say there's 200 billion in merger arb capital in the entire world, right? Now I'm just pulling that number out of nowhere, but say there's 200 billion, and as you said, the risk limit is 5%. So of that 200 billion, the largest position you get is 5%. That means there's a 10 billion risk cap on there. This is a $44 billion merger. So even if every merger arb decided we're going to have a 5% position in it, that's $10 billion. Would that be enough to close the spread on a $44 billion merger? I don't know, but it definitely could close it on a $2 billion merger. I don't know if it could close it on a $44 billion merger. So I don't know if that's true or not, but it kind of feels true to me, especially spreads are real for people who don't follow merger arbitrage. Anytime there's an announced deal that's a merger arbitrage, and spreads are really wide right now because ours have had their heads beat in, they're panicking, and I wouldn't be surprised if that plays into it here as well.
And I think another thing is probably the fact that because markets are down, there's just other opportunities.
Exactly. Yep.
And people are worried about what the price might be. The price might be like worse than you expect if the deal breaks, because it's hard to know how much things will go down. I mean, I think the other thing that's potentially at work here is it's such an idiosyncratic situation. Like I mean, I guess it's not the first time that a buyer has tried to claim some type of material adverse event and gotten out of the deal. So from that standpoint, there is a little bit of a playbook, but it's the first time you had like the combination of the single largest equity check written by a single person, right? I mean, 20 billion.
I think that's right. Yep.
The combination of like Tesla shares being down 30%. I mean, they're still way above what they would need to make him not have the cash available. Combined with Elon's influence in the tech world and corporate America. You have like the activists involved and some of the whether it's Silver Lake or Elliott, and sort of their board members potentially being conflicted that we can talk about because people are you have, so there's just so many moving parts that I almost feel like I think a lot of investors, maybe traditional investors more than merger arb people. Merger arb people are generally pretty good at like putting percentages on things because you kind of have to be. But I know for like the average person, it's like, well, there's two outcomes here. Either he somehow gets out of it or not. And so, I can't really tell the difference. It's sort of like, it seems like it's an opaque situation. And so I'm just going to split the difference and it's worth, halfway in between. It seems like that's what people are doing.
I am kind of with you. Let me, so Elon's trying to get out of this. And I know something's good when my mom calls me and asks me for questions. And I gave her a 15-minute long rant over the weekend about why I don't think Elon can get out of it. But the headline number, right? Everybody, before Elon right when Elon put out that tweet that said the deal is on hold, which we can talk about how you can't put a $44 billion merger on hold. It's either on or off. There's a merger contract, but he put that out. And the first wave of response you would hear is people control effing termination fee in the merger contract. And they would say, oh, well, Elon can walk for $1 billion. And I still hear people say, oh, well, if Elon really wants to walk, he can just write a $1 billion check. And yeah, that sucks. Like I personally cannot write a $1 billion check. I don't know about you. My podcaster money isn't exactly supporting $1 billion, but lots of people say Elon can just walk for a $1 billion check. And I think both you and I think / maybe know that is wrong. But I want to ask you, like,
yeah,
Elon's trying to walk. Why can't he just write a $1 billion check and get away?
Yeah, and I saw this from some smart people as well. Like Hindenburg Research put out a short report on Twitter when it was trading at $50, and that actually seems like a pretty smart thing to have done in hindsight, just because of how flaky Elon is. But I also saw Matt Levine talk about how it could be difficult to take Elon to court because like no one wants to take Elon to court, etc.
Yes,
but as far as the contract, people should know that what the Twitter board negotiated, and this is so somewhat standard in these contracts, is they negotiated a termination fee in certain situations, such as if they don't get regulatory approval, right? Which seems seems likely that they'll get regulatory approval. But in the event that he tries to just completely get out of the deal, they have something what's called, and I know you know this, but they have something that's called specific performance. And it's actually not, it's designed to not be a termination fee. It's completely separate from the termination fee. And it's the part of the contract that allows the judge to say, no, you actually have to specifically perform on what the contract says, which is you have to buy the company. And of course, there is clauses to that. Like, for example, everything that Twitter says, said in the everything that they represented in the various documents has to be not false in a material way.
Yes.
But it doesn't actually have to be all true. It doesn't actually have to be all true. They can have made some mistakes in their financial statements, as long as it's not false in a material way, which is very important, obviously.
And I know we're going to come back to this, but this is basically saying, look, if Twitter said, hey, Elon, at March 31st, we had $500 million and 70 cents in our bank account, and Elon finds out it was $500 million and 65 cents or something, right? He can't cancel the whole transaction over a nickel. But let's go back to the specific performance. So this is designed for exactly what Elon's trying to do. I mean, he's claiming he's trying to get out because of the bot issues, but I think everyone knows the bot issues are an excuse. He has buyer's remorse. He overpaid for Twitter. Tech stocks are down 20 or 30% since he signed the deal. Tesla's down 20 or 30%. And he's looking and saying, hey, Twitter stock price would probably be 20 if it was a standalone company right now. I'm paying 54. Frick, this sucks. So he's looking for an excuse. And this is what specific performance is designed to do, right? It says, hey, you've got buyer's remorse. That's not the reason. Delaware they have based their whole state's business on, we enforce contracts, right? Like, contracts and law is sanct here. And Twitter can sue them for specific performance. Will they win? That's for the courts to decide, and we would see. But it seems a pretty clear-cut case of, if you've got buyer's remorse, it goes to specific performance. You can't just take the break fee. Now, Elon could offer and Twitter could accept, but they can sue for specific performance if they want.
Yeah, and people should know that there's a long history of the courts in Delaware enforcing specific performance. Like, just 3 examples that I was able to pull when I was looking at this was just recent ones from the past couple of years. So in 2020, KKR tried to back out of buying a company called DecoPac, which I guess was a cake company. And they signed the agreement March 3rd, 2020, I think. And then literally, like, obviously 2 weeks later, no one was having birthday parties. And this like custom cake company they're seeing their business down like 40%. And so
I'm surprised it wasn't down 99%, to be honest with you. But yeah,
it's interesting because and if you go back through the filings, the company was trying to tell KKR, like, listen, the grocery business is booming, like, this is going to come back, like, blah blah blah. But KKR still tried to pull out of the deal. So they pulled out. They notified them that they were terminating the contract in April, and it went to trial, and the judge decided in roughly a year later, in like April, May, I think, of 2021, might have even been February or January of 2021, that they had no good reason to back out of the deal, and that they needed to perform on the contract. And I think KKR closed the deal like 2 days later or something. And this was a situation where there's 2 other interesting things. So first of all, as far as like a material adverse event, which is the language that these contracts use, like a cake company's business declining by 40% during COVID was not considered a material event. And so that's notable, just as far as like, so people understand the scale of what would have to happen to a particular company for it to be a material event.
Can I jump in here for 1 second? So I do think Elon, and I did a post on Twitter, I'll link it in the show notes, everyone can do, but he did an interview at an All-In podcast, and you could hear him use the term material 4 or 5 times. And that was not an accident, right? Because it's referred to as an MAE in merger arb circles, material adverse event. And as Evan said, it's when you sign a contract and the business that you're buying gets so destroyed in between you signing and you closing that you can go to a judge and say, hey, like, this is a different business than what we signed for. We can't buy this. And COVID was not an example of material adverse event, right? And before COVID, people didn't build in, there's material adverse exclusion. So, now people have a pandemic exclusion. If there's a pandemic that destroys your business, not a material adverse event. But a lot of people look at the bot issue and say, oh, this is a material adverse event. And it actually is not, right? Because a material adverse event refers to something that happens after the contract. What Elon's claiming is a breach of reps and warranty, where he's saying Twitter said it was less than 5%, and I think it's 25%. So it wouldn't be a material adverse event on its own. Anyway, I just wanted to clarify that because I do see a lot of confusion around that.
Yeah, and so a lot of the cases where buyers get buyer's remorse and try to back out, like this KKR case, a lot of times they do, they make a number of claims, and sometimes the reps and warranties issue is one of many.
Yep.
And but there's a very interesting case, another case where Boston Scientific was forced to close on the purchase of a company that there was like someone at the company was committing fraud, and so they had lied on some FDA submissions. And what Boston Scientific tried to argue was that the appropriate test was whether a falsehood on the financial statements would have been material to the buyer, i.e. them. And what they said was that the appropriate test was actually something very different. And they got this from the case called Acorn, which you probably are aware of. Is like,
oh, I'm aware of Acorn.
Yeah, you're aware of Acorn. So Acorn was like the one case, I think, in the history of Delaware where they actually concluded that there was a material adverse event.
Yes.
But the test from that case was the event has to create a durationally significant loss of earnings power. That was the test. And so I think in this case, I mean, even if the bots number was off, the idea that it would change the expected earnings power of the company in a durationally significant way, it just seems to me extremely far-fetched and basically impossible.
And for those who don't, actually, I'll talk about Acorn in 1 second, but the Boston Scientific case that you mentioned, do you know who they were suing? Do you remember the case? Just so people, including me, can go look the case up a little further.
At Boston Scientific, and it was Channel Med Systems.
Okay. And just so people, the Acorn case, they had a buyer, I believe it was Fresenius.
Yes.
Grade A buyer. And after the deal got signed, someone leaked to Fresenius and they investigated. And it was literally like Acorn would make drops that go in your eyes, right? So you needed a complete clean room, because if you put something in your eyes, it better be pretty darn clean and pretty darn pure. And there were literally roaches running around in the clean room, right? Like, it's bad enough there's roaches running around in the kitchen where your food is made, but there were roaches running around in the clean room. They were lying to the FDA. And I know many people, including myself, who this went to trial, and Acorn said, we're suing you for specific performance. And Fresney said, clearly there's been a material adverse effect. And I know people, including me, who looked at this and were like, I don't know, like, there's never been a material adverse effect ruling in Delaware. I think Acorn might win this. And Acorn lost that and basically immediately filed for bankruptcy after that. So, but that's literally how it can't be, hey, we're in a recession, your earnings are going to be down 5%. I believe what the judge ruled in Acorn was like, you need to have something that's going to vaporize like 50% of your earnings forever in order to be a material adverse effect. So I know you said there were 3 specific performance cases that you looked at that you thought were interesting. You mentioned one, the KKR, you mentioned Boston Scientific. What was the third one?
The third one was Hillrom versus Barty Diagnostics.
Mm-hmm.
And in this one, there was a big change in, basically it's another buyer's remorse case if you look at what the judge says. And it was a case of Medicare rates changing significantly, and they were still not allowed to back out of the deal.
Yep.
And the timeline, one thing that I wanted to do, because people were asking on Twitter about the timelines, and that case was decided in July 2021, and they first signed the deal in January of 2021.
Yep.
So I think it depends on whether the court grants like fast track status.
And they're normally going to grant, I think it's technically an expedited hearing or something. They're normally going to grant it because, the business is in a lot of flux, and judges don't like businesses. Like, they realize for all parties involved, if you go through a normal trial that takes like 2 to 3 years, they realize that that's really awful for all parties involved. Like, for Elon, he would have 44 billion like overhang. For Twitter, they don't know if they can fire people. So judges realize we need to get these things on quickly if there's a material adverse effect. I want to go back to what you said, buyer's remorse, right? I think we've seen several cases of buyer's remorse. You've listed a few, but one I thought was really interesting because it kind of rhymes with what's happening here was Louis Vuitton Tiffany. And I'll let you tell it if you want. I can tell it, but do you read any parallels into the Louis Vuitton Tiffany story to kind of Twitter Elon?
Yeah, it's sort of similar. It seems to the KKR case. Well, KKR and LVMH Tiffany are probably the most similar, but both of them kind of rhyme with the Twitter case, where you had a business that when you buy it, right after you buy it, something happens, and the markets are down, business is down. I mean, in Twitter's case, it's not clear that the business is down, but at least the markets are down, 20, 25%. And so, then the buyer just tries to use essentially the threat of pulling out of the deal. And of course, the thing that underlies that threat is the fact that your trading price of they know that the board is looking at the markets and saying, well, hey, if we do lose this somehow, our stock is going to fall so much because the markets are down. Like, for example, like with LVMH and Tiffany, obviously in March, April 2020, stocks had fallen a ton. I forget actually what the time. I think by the end of the summer, though, they came to an agreement, though. So I forget exactly what the timing on that was.
Just for listeners, because I'm going to send this to my mom, and I'm sure she wasn't following LVMH Tiffany at the time. Yeah. Just for listeners who weren't familiar, Louis Vuitton, one of the world's largest luxury goods company, announced a deal to buy Tiffany's. COVID hit, and Louis Vuitton, they are run by a very smart, one of the richest people in the world. And they said, hey, guess what? We'd probably be able to buy Tiffany's for less today than we did a couple months ago because of COVID. And they tried to throw all sorts of excuses to pull out of the deal. But the bottom line was they had buyer's remorse. They knew they were overpaying. They tried to pull out. Tiffany sued them for specific performance for breaking the deal. And eventually, it was really weird. Like Louis Vuitton actually went to a French minister of some form and had them write a letter to Tiffany's that said, hey, Louis Vuitton can't close this deal, even though the French regulatory body had like zero jurisdiction over the deal. It was very strange, but they were pulling all the strings. And eventually they settled, and Louis Vuitton got a token haircut. The stock price went from they were going to buy Tiffany's for $135. They cut it down to $130, $150, if I remember correctly. So, that's still tens and hundreds of millions of dollars that they saved, but it was a very small cut in the grand scheme of things.
And how large? Where did Tiffany? I forgot where did Tiffany trade in the meantime?
It's tough to remember because this was height of COVID. So there were margin calls going on and everything. Right. But if I remember correctly, I don't think the stock ever went materially below like 100 or 105. So it traded at a 30% spread. And I think people for a long time, I read a lot into the Louis Vuitton Tiffany thing, and we can also talk Lear Abbott, which is another one I like. But, I think there's a long history of if you have buyer's remorse, a court is going to force you to close. Right. I do think even at the height of COVID with Louis Vuitton, people did look at Louis Vuitton as a rational animal and said, hey, if the judge orders him to close, he will close. If Tiffany's offers him a big enough discount, like he looks at long-term, he will. Whereas the one difference I see with Elon, Twitter, Tesla is I don't know if people look at Elon as a rational animal. They think he's just like such a wild card. He might, he told the SEC, he said, SEC, 3-letter word, middle word, Elon's. I'm going to give you a hint. The first S was suck, and you can figure out what the C was. People just look at him. If he goes to court, he might just say, screw the whole thing. Or maybe he files for personal bankruptcy. Like, people don't know what Elon's going to do. And I think that's getting baked in here.
Yeah. And I think that's interesting to bring up because I have a kind of a theory around this. So, I mean, a lot of the ways that Elon has kind of messed around and like kind of skirted rules throughout his career are, the rules are a little bit fuzzy, like as far as, what types of things you can tweet out, like, disclosure rules. And I mean, obviously he broke some rules as far as like when he filed some forms and whatnot with the Twitter situation. But I think, what was the word you used to describe him? Like chaotic or,
he's not a rational actor. He's chaotic. He's a salesman. I mean,
he's a non-rational. Yeah. He's non. So I think the Delaware courts are where non-rational, like chaotic actors like go to die. Like I remember So we were involved in the Dell appraisal case at my old firm.
Yep.
And this was in front of Judge Laster.
I know the case. I know the case. I know the judge. I know. Yeah.
And so I will never forget. There was a guy who was like he was like one of the top people at either Bain or BCG. I forget which one. And he was testifying. He was being questioned, and he on cross-examination, he wouldn't like directly answer the question. And the dressing down that he got from Judge Laster was everyone in the courtroom was like, oh my, like we were like all like the guy's face turned red. Like I thought he might cry actually. Like, and I just remember thinking like, this judge does not give a crap about like who you are, like what, like how rich you are or whatever. Like if you go in there and you try to bullshit him, you're gonna get your ass. It's not gonna go well for you.
Look, I'm with you. I agree. Like Elon's gotten out of a lot of stuff. I thought Elon should have lost the SEC case. I thought there were a couple cases he lost, but the facts and law are going to be pretty clear here. And maybe Elon can prove that Twitter was just flat out lying about mDAUs and all this, and he should get out of the contract. But I feel pretty good. Like if the facts and law are on your side and there's no smoking gun here or something, like courts are aware if you're a liar, if you're a huckster, it's where you get stopped, right? You can look at in the current environment, you see a lot of people who lie all the time when they're on TV and stuff, but then they go to a court and they're asked something and they're smart. They know, they say, I don't recall, I don't remember, because you lie, you perjure yourself in court, the consequences, that's the one place you can't really lie, and it will come back to bite you if you are proven wrong.
And like, I think Elon's smart enough that like these arguments he's making, he's not even going to bother making them in court. Like it's not even going to he's not going to put in front of Travis Laster the argument that like like him counting 100 of his followers is like the equivalent to some type of evidence about their financial statements.
Let's go back to, so this goes back to the mDAU point, and I do want to go back because I might disagree with you, because the one downside here, like I think Twitter will win in court, but for Elon, what's the downside to going to court, right? Like you go to court and you don't perjure yourself, right? So you don't get yourself like thrown in jail or anything, but you go to court and you just rant and rave and scream about how the mDAUs and some material adverse effect, and you get laughed out of court, right? The judge's rules in Twitter's favor at 6 months. The downside is you have to close at 5420 and you spend a couple million on lawyers' fees, which it doesn't matter to you. And maybe you boosted the value of Twitter because you're increasing Twitter engagement by this crazy court case you're doing, right? And the upside is you get the Hail Mary and they let you break the deal, or the Twitter board is so scared that your Hail Mary is going to pay off, they come to you and say, hey, we'll take 46, but it needs to be buttoned up. All the money's in an escrow account. Like we signed this, you close the next day. It seems like it's all upside for him if the longer he fights this, right?
Well, and I think that is a perfect description of why he will fight it, may very well fight it most of the way. I mean, I think what you describe is probably why he has a huge incentive to fight it all the way up until the trial. Because I mean, how long is the trial going to take? Like, I mean, I don't think the trial itself would take more than like a week or something, a few days even. Like, I don't know.
There'll be the lead up and stuff, but yeah, a week, 2 weeks.
As far as like his time, it's not going to take much. But like, I think he is perfectly incentivized to continue kind of messing around with his public statements and kind of just trying to see, like, kind of like throw spaghetti at the wall and see if the Twitter board, just for some reason caves, despite the fact that the facts are on their side. I completely agree. I mean, we'll have to see whether he's actually willing to like go to Delaware and sit there and act like an idiot and rant and rave like you said, because at that point, I mean, if Twitter is willing, if Twitter has like done all the discovery, like, I mean, the other thing is the discovery might not be great for him. I mean, of course, it's all privileged except for stuff that's being used in the actual trial, which means like, you know, they're going to have, you know, they're going to have to do like keyword searches of all his text messages and his email and whatnot. And I mean, some pretty damning stuff would probably come out as far as his actual state of mind with respect to like this deal. Like, I don't really, I kind of think that the discovery would probably show that it was just like you said, it was just a very transparent case of buyer's remorse, and there's not really a real thing here. And at that point, does he really want to keep going? Does he really want that to all come out? I don't know.
For anyone who's never been, like, Delaware, lovely state, one of my best friends, he listens to the podcast, so he'll probably hear this. He went to school at University of Delaware, like, lovely state, but it is not fun going to Delaware and being in trial. I've done it a few times. I served on a creditor committee. Like, you have to go to Delaware. You're in the courtroom for a long time. I'm sure Elon's got handlers who can roost that, but it is not a fun experience. I don't know anyone who would be like, yeah, let's go do it. You know, let me ask a few questions that are just kind of lingering around. I'm going to hop around. Look, I think one of the interesting things here is Elon is claiming that, hey, Twitter's disclosures represented more than 5% of their monetizable daily active users, or 5% or less were the bots. I think it's way more, right? Twitter, Elon's claiming that. And there's two interesting angles that I'm just always back and forth on. I want to get your read on. Number one, obviously bots were a known problem. Twitter's been highlighting them in their 10Ks for years. Elon, in the deal press release, Elon says, one of the reasons I'm buying Twitter is to fight back on the bot problem, right? And now Elon would say, well, he even said it on Twitter. I relied on Twitter's filings when I made this, and now I think that the filings are misrepresented. Do you read anything into, hey, this was such a known problem, it's going to be difficult for Elon to back out on that? Or do you think, hey, if Twitter misrepresented it, he will be able to get out on it?
I mean, I think that technically my understanding of the law and the way these contracts are written and interpreted is that if there really was a misstatement in their financial statements that would cause a material adverse effect, then I think he could probably still get out of the deal regardless of whether or not like someone could prove that like he might have suspected that because it's one thing. I mean, it is one thing if like let's say it turns out that 100% of all of even the monetizable daily active users, 100% of all the monetizable daily active users were bots. No one actually uses the platform, and
it's just you and me DMing each other every now and then about interest.
Yeah, maybe Elon himself is a robot, but therefore like the business was inevitably going to unravel once advertisers figure this out, which I mean, of course isn't true, because they can see when people come from Twitter. They can like do ads that are only on Twitter, and they could see like how that impacts like polling data and purchases. And like companies understand, like digital companies more than other ones are good at like helping the advertisers understand like how their ads are having an impact. So I don't think it's really credible. But in that situation, I don't think it would save Twitter to say like, well, he knew that there was some bots. Like, yeah.
Let me go to a different one. I think that answers this, but let me ask another. Elon, he was so eager to buy Twitter that he waived due diligence, right? And I was of the opinion, I think it's going to lead to a really negative paper trail for him that he waived due diligence. But I've had lawyers say, hey, you can't read anything to waiving due diligence because he can say he relied on Twitter's statements, and if they were materially false, as you said, he could get out. But I don't know, because my two things would be, Twitter makes very clear in their financial statements that our mDAU bot number is an estimate. And if Elon, who he knew about bots, if Elon was really concerned about bots, he could have gone and looked at how they calculate them, the algorithm. They could have shown him the assumptions. He could have tweaked them. That would be number one. And then number two, Elon says, hey, this is a material adverse thing because advertisers are going to be bamboozled by it. And as you said, advertisers know that bots are a thing, and advertisers figure out a way to judge their ROI. And in due diligence, like I was at private equity before, I was at consulting before. One of the first things you do in due diligence is you would call up a major Twitter advertiser and say, hey, talk to me about why you choose to buy at Twitter. How do you adjust for bots? How do you adjust for getting gamed and stuff? And he had the opportunity to do all this due diligence and he waived it. I don't know. I just think even if that's not a smoking gun, I do think a judge is going to look really negatively on that. Yeah. But what do you think?
Yeah, I agree. I think that it's not technically like an out. Like they can't technically say like, well, just because you didn't do due diligence means that like anything we said in the financial statements,
anything goes.
Because he can actually say, well, the whole reason why I was able to waive due diligence to get this deal done so quickly is because I thought that your financial statements were accurate.
Yep.
So he can kind of use that defense. But I do think it will help a judge see through the very thin veneer of the buyer's remorse situation. It just makes it all the more clear, because while it's not technically a legal out if Twitter was like it completely like on purposefully lying about the number of bots that are in the monetizable users, I think what it does is it shows that this is not really something that Elon thought was like a make or break thing for the deal. Like it just creates a very transparent situation where he's just obviously lying, because like you said, regardless of whether, because it's entirely possible that the bots thing is a major problem. Twitter was accurate in how they described their estimate, and that Musk could have learned something important that maybe would have made him not want to buy it given the bot issue if he did due diligence. And so the judge is going to say, like, in that scenario, it would have been if bots were so important, it would have been really important for you to do due diligence, because like you can't really rely on just like backing out the next day over supposed lies in the financial statements. So I think what it does is it exposes the transparency it exposes the baldness of the lie. And so I think that will be very tough for him to overcome.
And due diligence, I agree with you, right? Like they're going to be able to go in and get all of Elon's thing. And if there is one email after the deal was signed that's like, shit, tech stocks are down a ton since I signed this, my financing is going to be more difficult, I kind of wish I hadn't signed this, that is going to be such a smoking gun. Now there is the counter to due diligence, right? Like if they get to due diligence, or sorry, discovery. Sorry, I'm saying DD because discovery. If they get to do discovery on Elon gets to do discovery on Twitter. And I do know some people who are thinking, hey, again, this is a free roll for Elon. For a couple $1 million, maybe he can break this deal that he majorly overpaid on. Do you worry at all about diligence, where he goes in and he finds one smoking gun from a mid-level employee that says bots are way worse than we expected or something?
I don't know, man. I mean, you'd have to argue that even if they knew that there was more bots, like he would still have to prove that it would cause a material adverse effect on the overall company. And I just don't see how, because as you said, everyone already knows there's bots, and like whether it's 5%, 10%, 20%, like it doesn't seem like it's just very difficult to prove that that's going to cause a material adverse effect. Like the bar is so high, it's literally only been jumped by one company that immediately went bankrupt afterwards, right? Like Twitter is not going bankrupt. I can guarantee you advertisers are not like, oh man, there's bots. Elon said there's bots, let's pull all our ads. Like that's just not what's happening.
It's one of the things that, again, I hate to keep referring to the All In podcast, but this is the podcast he did a week or two ago where he went on and every host is like, oh yeah, Twitter's so bad with the bot problem. It's like, you're talking to the man who's supposed to be the best business mind of our generation. He just signed a $45 billion deal. We've known about Twitter bots for ages. And 2 weeks later, all of a sudden he discovers that bots might be a problem and everybody's applauding him for pointing out this thing. Like, what are you talking about? It just boggled my mind.
It's so transparent what he did. Because obviously, I mean, also like what changed in any of the bot information between when in the last month. Like he only signed the deal in April. Like, I mean, nothing changed in the last month with respect to bots. The other thing about the All In podcast is like I like listening to them because they are smart and they're kind of like tuned into the VC world. And but I often think they're a little bit, they're just giving you like the zeitgeist of, like, for example, like when Netflix is down like 30%, they're all saying like, oh, I never use Netflix, like blah, blah, blah. Like they're like, oh, I'm HBO all the way. Like they're just like piling onto whatever the popular thing is, it seems. And you know, and Elon's a popular guy, so they're all team Elon, it seems.
Yeah, look, nothing to disagree with. It's just like, it really got my hair up that they were so egging him on when it was like, this was a disaster of a deal from the start, and you're egging him on for this thing. And then one of them, the host who was like really egging him on, was trying to raise an SPV that he would make like tens of millions of dollars off of. Right. Trying to raise an SPV to support Elon taking Twitter public, while at the same time encouraging him like, these bots are a disaster. It's like, wow, that's really I don't know the term, but it's not good. It could not be great, Bob.
It's very strange, unless you think about the fact that everyone that is on Elon's side of the deal, they actually would love to somehow get a lower price, right? So actually, maybe that's no worse than just talking your book, right? Because like, if the bots are an issue and it causes Twitter's board to, you know, cave for absolutely no reason, like they just blink and they say, fine, screw it, like you can buy it for 46 or something, that would actually help his SPV. So maybe he's just you know, he's just looking out for
I do hear you, but it's not a great look where you're out trying to raise money from smaller investors in a vehicle that's laden with fees at 54.20, and while you're doing that, or 2 days after you've sent that email out trying to do that, you're bashing the Twitter deal as overpriced because of the spot issue. It just wasn't a great look for me. Let me ask again, I could go everywhere this thing, but let's drill it on the financing here, right? Because one of the risks to Twitter, and my head goes crazy every time I try to figure this out. When the deal was signed, the biggest risk to the deal, aside from Elon being mercurial, was financing. And this has committed financing, but a big piece of the financing was a margin loan on Elon's Tesla stock. At the time the deal was signed, if I remember correctly, if Tesla stock went below 600, I think where the margin call would hit. And, you know, a margin call is not, hey, the financing has gone. The margin call is, Elon, you have to put up more margin or try to find a replacement financing, but it would have let him get out of the deal if he got margin called and he couldn't replace the financing, right? But right. Since then, he's raised a lot of equity from co-investors, from selling Tesla stock, from all this sort of stuff. And because of that, the margin call level has gone down. However, I don't know where exactly the margin call level is currently. So I want to ask you a couple questions here. And I realize I'm throwing a lot at you.
Yeah.
What do you think about the financing risk here? Do you know where the margin call level is at this point?
I don't know. I don't know exactly what the level is right now. If you kind of back out because it was like 7 billion in external, like either current minority investors that are rolling their stake or external capital, right? Mm-hmm. And he's already sold 8 or 9 billion of Tesla stock. I forget.
I think that's right. Yeah,
the actual number was. And at the end of the day, he has to come up with a 21 or 22 billion dollar equity check, and then a 12 or 13 dollar you know, he has to put 12 or 13 billion of margin loan essentially. And you know, but he has, I mean, he has two things. Obviously he has you know, over 150 billion dollars worth of Tesla stock, even at current prices. Some of that's already encumbered by margin loans. But he also has, you know, his 40% or whatever of SpaceX that he owns. I mean, so one thing that's interesting is he can't just, if there is a margin call, he can't just back out and say, oh, it's no longer, like you said, it's no longer. He has to use like reasonable commercial efforts to seek financing. And actually, that was an interesting part of the KKR Decopac decision. Their financing their financing actually, they claimed it wasn't available. And what happened was it wasn't, basically after COVID hit, KKR went back to the lenders and said, hey, listen, like we need all these concessions in terms of leverage multiples, because the company's profitability has fallen. We need like all these concessions, blah, blah, blah. And the lenders said no. And they claimed that that made the financing not available and that allowed them to walk. But the judge said, no, actually, because the banks were still willing to lend at the original on the original terms, you can't just, essentially you sabotage the financing.
Hey, you said you sabotage the financing. That brings me to another interesting point. I do wonder. So I think the Tesla like kind of margin call level is around 300 to 350. It might be as high as 400, but I don't know for sure. Yeah. But I do wonder if Tesla, the stock has to get cut in kind of half for this to come up. But if it happened and Elon went and said, Judge, I can't raise this money, like he has to use reasonable best efforts. I wonder if Twitter could go back and be like, Judge, he can't raise this money because he's out here in breach of contract. This is another question I was going to have. Everything he does on Twitter right now is in breach of the merger contract that says basically he won't slander Twitter or the deal. In breach of contract, he was out there blowing up the deal, telling lenders he didn't like this, all this sort of stuff. I wonder if Twitter could argue that and a judge would say, hey, Elon, you actually do still have the assets, right? You could sell SpaceX. You could sell all your Tesla stock. The reason you can't perform is because you blew up your own financing. I wonder if a judge would hold him to that and make him perform on that. I think it's low likelihood, but I think it's a possibility.
Yeah, I mean, it does seem like, I mean, he is obviously saying things that are negative about Twitter in general, right? So I agree with you. I do think it's possible that a judge could look at his comments and say, you contributed, and because, like you said, it was in the contract that he's not supposed to disparage the company for this exact reason, right? Like one of the reasons is so that the deal goes through, the banks don't get scared, the banks don't pull the financing, other equity investors, write their checks, etc. So yeah, that does seem like a possibility to me, although I'm not an expert on like the legal or the precedents there and whatnot.
The co-investors in the deal, right? And there's a bunch of co-investors. One of the Saudi Arabian foreign wealth funds owns like 4.9% of Twitter and is just going to roll their equity into the deal. I believe one of Brookfield's funds writing $100 million check to co-invest in here. Does how Elon's talking on Twitter at all, does that impact their obligation to fund the co-invest or anything?
I would love to know about the discussions between the co-investors and Elon. I mean, I actually wonder if part of what's going on here, I mean, who knows, but I wonder if part of what's going on here is the co-investors saying, listen, I know we're committed here, but like, please try to get us out of this. Like the stock would be 30, 40, 50% lower. Like, we don't really want to do this. Like, please let us out of this gently. So I don't think, I don't think it would affect their contracts. I don't think he has filed those contracts as far as their commitments. But even if it did, he would still be on the hook because anything that he does to personally like affect the availability of financing. I mean, he has to actually proactively try to keep the financing, and if he doesn't, the judge will rule that he still has to buy the company.
One of my big worries, and just making a complete shift, one of my big worries, which I have gotten much more comfortable on, but look, Twitter is a mess. This drama, this is a circus with Elon Musk, and one of my big worries was Elon's going to try to break, and the Twitter board is going to look at that and say, we've got a lot of work to do. Elon is a wild man. We can't rely on him. There'd be some back and forth, but eventually they just say, let's just take the $1 billion check from Elon and let's walk and lick our wounds. Or maybe they could get up to $2 billion, but the difference between getting a $2 billion check and walking, and the stock price would go down a lot. We can talk downside in a second, versus specific performance is huge. So I was kind of concerned for a long time that the board just wasn't going to have the cojones to go and like sue Elon in court. I've gotten more comfortable on that, but I want to ask you, what's the risk that the board, the management team kind of just say, hey, it's Elon's being Elon?
I mean, it's obviously been the biggest risk from the beginning, given like the other fact patterns. And it's very strange because it's like one of the only times where, I mean, maybe you can think of another one, but I can't remember a situation where like all the facts are on one side and the main thing you have to worry about is just like people not giving a shit or like people not doing their fiduciary duty. Like that is pretty rare in corporate America, that you have that as like your main risk. I mean, usually it involves some like very strong conflicts of interest. But in this case, I mean, obviously that has been a worry. And of course, there's a couple of them that are conflicted, right? I mean, you have Jack Dorsey, who is, if you look at the merger docs, he was talking to Elon for a long time about taking it private. He's like on team Elon like all the way. Like they're clearly like just boys.
Yep.
And so and he's been rumored to potentially be rolling his, I don't think he was on the filing that Elon did as far as like committed financing and people who are rolling their stake. But I think people have been talking about him, he has been in talks to roll his stake into the new entity. And I mean, clearly anyone that's rolling their stake into the new entity is conflicted because, you actually want a lower price in that scenario because you own either there'll be less debt or you'll own a higher percentage of the enterprise, including debt, right? So, I mean, I think also it's the Egon Durbin, who the Silver Lake partner, Silver Lake's also rumored to be potentially involved in rolling their stake into the new entity. So he's also potentially conflicted, but everyone else is pretty independent, I think. And I know, people have heard people have heard rumors about how the board feels about Elon. I mean, if I am the board, I am furious at how he is trying to rip up a contract in broad daylight through like the most transparently, in the most like brazenly dishonest way. I would be absolutely furious, and I would be like just salivating over the opportunity to take him to court, honestly. So I don't know. It doesn't. Nothing that they've done so far has explicitly shown me that that's not how they feel, because they haven't said much, but there was like a couple articles, there was a couple internal emails and stuff saying that, where they're telling their internal people that like there's no such thing as putting a deal on hold and whatnot.
So if I can disagree with you on, I think the board, I've gotten much more comfortable based on, again, my notes will be my post will be in the show notes. I've gotten much more comfortable. So on May 17th, they filed a press release that says Twitter files preliminary proxy for acquisition by Elon Musk. And in it, it said, Twitter is committed to completing the transaction on the agreed price and terms as promptly as practical. Right. Now, maybe you look at that and say, oh, that's boilerplate. But I have never seen a company include that line in a filing of, I don't think I've even seen I haven't seen a lot of press releases saying we filed the prelim for a merger agreement. I've never seen a company include that line. And that, plus there was a Bloomberg article that said the board was going around telling people, we're going to close this on terms. We're willing to, I think they even said, we're willing to go seek legal remedies if we're going. So I've gotten a lot more comfortable there. And then the second thing that I thought was interesting, I'll just rant for a second. This deal was agreed on April 25th is the day they put the press release out saying Elon Musk agrees to acquire Twitter. They filed the prelim proxy for this deal on May 17th, April 25th to May 17th. That's what, 3 weeks? $45 billion merger, prelim proxy in 3 weeks. I can't think of, I've never seen anything that close. I mean, maybe somebody with better skills on the computer can find an example. I can't think of, that's like tender offer fast for getting those docs filed. Normally it takes 2-3 months to get the prelim proxy out. They filed that so quickly. And if I was the board, my best strategy would be let Elon rant and rave. We're going to meet all of our requirements. We're going to file the proxy. We're going to get the shareholder vote approved. We're going to get all the regulatory stuff done. And then we're going to go to Elon and say, every condition has been met. We would like you to put $45 billion into a checking account. Yeah. And Elon cannot, and we're going to sue, or Elon can, and we'll close. Right. And based on what I'm seeing by that prelim timeline, Twitter just casually saying, we're committed to doing everything on terms. It seems like that's the strategy they're taking.
Yeah, I mean, I think it's and it is the best strategy, because there's nothing that they can say is going to at least in public, nothing that they can say is going to certainly convince any of the Elon fans. I mean, the only thing that matters is whether they get regulatory approval, whether they cross all their T's and dot all their I's. And yeah, I agree. That's I actually didn't think about that, the line, because I saw that, but I didn't actually think about how rare that was, because of course every company that's getting acquired for a large premium is trying to get the deal done, right? But they just threw that in to make absolutely sure that everyone knew that they are doing their best to get the deal done on the original terms.
My partner at Rangeley, Chris, he likes to say one time he was listening to Britney Spears and somebody asked her about if she was a virgin, and she said, "How dare you ask that question?" And if you were just listening, you wouldn't have taken anything from that. But if you had listened to her the past 5 years, every time she'd been asked, she said, "Of course I am." Yeah. So it wasn't what she said; it was the change in what she said that you noticed, and that's kind of how I view that proxy line in a not too appropriate analog. Let's see. Last thing I want to ask. One of the crazy things you'll hear, and I think the Matt Levine had this, is what if Elon goes to court and he loses and a judge orders specific performance and Elon refuses to specifically perform? Yeah, so I think that's a crazy risk, but I'll flip it over to you.
Yeah, I mean, I think he goes to jail, like, because so if you look, you can look up. There are cases where the court of chancery has ordered people to jail for contempt of court for failing to follow a court order. Like, I don't think it's ever happened in the case of a company failing to specifically perform on a merger agreement, because that's just completely nuts. Why would you do that? But like if you agree to, like, and it was Gore versus Wu. And if you look on DelawareLitigation.com, which I think is just the Court of Chancery, the Delaware court's like website, or it might be a third-party website. I'm not sure. It's like /Wu order for prison, and I'm just like imagining that being like Musk order for prison. I mean, there's just I don't think he would ever let it get to that point. But I mean, at the end of the day, if you don't do what the court says, like they can fine you some ridiculous amount, but it'd have to be like $1 million a day or something, or $5 million a day. I don't know what.
If you run the conspiracy theory down, I've known people who've been like, well, Elon's in Texas. He's just going to go to the governor of Texas and be like, don't extradite me to Delaware. This is political prosecution, and they'll try to score political points. And you can keep running down that. But what I come to is, look, Delaware knows if we let a billionaire get out of specific performance because of this, again, the whole merger contract system is screwed. And guess what? There are a lot of counterparties to Elon that Delaware can start going after. Delaware can go to every bank and say, hey, all of you are headquartered in Delaware. You guys do a lot of business here. You guys want to keep doing business? We're putting a freeze on all of Elon Musk's assets. Like they can just keep escalating. Yeah. Yes, Elon's a wild man, but if a court orders specific performance, I feel pretty good that we're going to recover there. Maybe he ends up in jail. Maybe he doesn't. I think he's not going to, because people are going to say, hey, this is one thing you don't want to mess with, but they're going to find a way to get the assets. Let's see.
Tesla's a Delaware company, right?
I believe so. I would be pretty surprised if they weren't. But Tesla's not a party to the contract. I think where you're going is,
as far as seizing his assets, right? I mean, they can certainly put a freeze and not let him transfer any Tesla shares.
Yeah, but that would probably be easier to just go to the banks, though, right? You just go to the banks and do it. But yeah, if he loses, they're going to recover unless he takes his Tesla shares, lights them on fire, and then flies off to Mars or something. Let's see. I've got a few floating notes around, but anything else you wanted to say? Anything you think we missed here?
Sure. Yeah, I have one thing. Do you think it's probably too early for this, but what do you think the likelihood is of someone like a Carl Icahn or a Dan Loeb or someone like that? I think Icahn would be the perfect. It would like fits his kind of MO the best. But I'm curious what you think about that.
So what Evan's referring to is an activist, most likely, comes in, buys up 5% of Twitter at today's 37 price, and they say, this is an ironclad contract. I am going to like force the board to enforce on this. Like we'll replace all the boards before before the contract even breaks. And our one goal is to go force Elon to encourage on this contract. I wouldn't be crazy shocked. I agree with you, Carl Icahn fits. If you want to get really fun, if you're Jeff Bezos, why not buy up 5% of Twitter and say, hey, I'm forcing Elon to specifically perform on that? I think it's possible. Look, I think this is a really good risk reward. It is completely idiosyncratic for the markets. This is, if you go back to the 80s and 90s, this is one of the things that activist funds were like kind of formed to take advantage of. You think of John Paulson making his fortunes on CDS, a non-correlated asymmetric trade. Like, yeah, there's a lot of people, and a lot of these activists have legal backgrounds. I think there is a chance.
I think Icahn would fit particularly well because he a lot of what he does, he tries to couch it in terms of sort of improving the functioning of corporate America.
Yep.
And I mean, this fits that to a T, because I mean, this is really a question over whether contracts matter and whether boards are willing to pursue the fiduciary duty of minority shareholders, even at the expense of pissing off the world's richest person. And so I can't, I can't think of a better person to enforce something like that than Uncle Carl.
Yep. I guess the last two things I've just got floating around. I mean, we've been saying specific performance. I do think one downside I've heard from people is while courts will rule for specific performance, courts really don't like to go to specific performance just because they're forcing people to close. Like, I do think the courts are going to be nudging everyone, mediate, settle. So I would not be surprised if you see a slight price haircut here, but Louis Vuitton, Tiffany, height of COVID, they cut from 135 to 130, 150. Alir Abbott, which I mentioned in my note, that was a disaster. That business was falling off a cliff. There was some fraud. There was a DOJ subpoena for bribery, foreign corrupt practices. That went from 56 to 51. Like, the precedent is everyone goes into mediation and the buyer realizes, ooh, we have a really bad case. If we can get a token haircut, that's probably the best we can do. I think that's probably the most likely end game. Again, Elon's a wild man. Maybe he just runs it out to the end. But
how can the board? I mean, I guess if you put it all in escrow or something, but like,
yeah,
how can the board write a new contract when he just, pooped on the last one?
In order to get something, you have to give something. And I think you say, let's choose 50 as the number. Elon, we will close at 50. That will save you $2 to $3 billion, which is big in terms of the margin loan. It's big in terms of everything. That is a mammoth win for you with how poor your court case is. But you need to put everything into escrow. And the moment all the conditions close, like, it's not even you transfer assets. Like, the moment we just release them from the escrow account, right? Like, we've got 20 billion in escrow. We've got a claim on all your margin loans. You agree to waive every single condition. Like, I think that's what you have to do.
I like how you had to explain why 2 to 3 billion is a lot of money. The margin loan and it's important.
Well, you in a $44 billion deal, $2 to $3 billion, it's material, but it's not. It's probably not the most material. But to Elon, who he's getting a lot of debt, that cuts a lot off the equity check. It's a huge amount for him. So I do think that. The last thing I wanted to say, just when I was diligencing this morning for it, I discovered Hexion versus Hutzman. Are you aware of this?
No. What's that case?
Listeners can Google this. This was like a 2008 case, so it is very dated. But it was another case where buyer alleges material adverse effect, and there's I'm saying it because there's some really clear rulings on it. It says, hey, material adverse effect, the buyer lost. It says, if you're the buyer, the burden of proof is on you to prove that material adverse effect. And then it goes to a lot of the other things that you talked about earlier. It has to be a long-term view of the material adverse effect. Miss forecasts don't count it. It's just a lot of things that back up everything we said. But if anyone wants to Google Hexion versus Huntsman, I thought that was a very clear case. Now, in that case, it is interesting. Huntsman won, but I don't believe they got specific performance. I believe they ended up settling for, this was height of financial crisis, but they ended up settling for like a boatload of money, but it was not specific performance. So I'll have to diligence that a little bit more, but that's an interesting one.
Yeah, I mean, one thing that we've been a little bit worried about is that that Twitter would try to negotiate for some like giant settlement that would maybe seem like it was going to make them whole, but the amounts would have to be so large. I mean, you're talking about however many, like, what is there, like 800 million shares outstanding or something, times times like $30. I mean, it's gigantic.
Ignoring if they got like a $30 billion settlement check or something, right? If Twitter breaks tomorrow, and you can say they get the $1 billion break fee, you can say they don't, but if Twitter just walks away for some reason, where are you running the downside to for Twitter?
So I think if you look at, so I mean, one interesting thing is, I mean, normally in a case like this, if the deal breaks, it should have, if the person was paying a premium, it should have like gigantic downside because you have to like reverse all that premium. In this case, interestingly, like most of that premium has already fallen away. Like the stock's gone from 50 to 37, and I think it was trading at like 33, 34 before, like low 30s. However, the market's down since then, right? So I think my numbers are like, if you do purely based on like the return of the market, it would be something in kind of the mid to high 20s. But if you then assume that there's like negativity around the stock, and I don't know what your take is on their earnings report that came out, like maybe it goes to low 20s. I don't know. What do you think?
I was using low 20s, but I had a couple conversations with people last week, and one person was like, they don't have a position, but they think they've got a great case. And they were also like, if you read the proxy, Twitter's in the proxy, companies give earnings forecasts, right? Not forecasts, but they say what their internal forecasts are. And their 2023 and 2024 earnings forecasts, I believe, were well ahead of where the street is. So they were like, look, maybe the downside isn't as big as people think. But then I had another person who was like, Twitter told you 18 months ago at their investor day what their earnings and mDAU targets were, and they're nowhere close to that. Like, who's going to believe an earnings target in the proxy? Right. And by the way, Twitter's a disaster, and Elon Musk's proving this. So yeah, you can run your downside to 2250 if you want. Like, that would be kind of 9 or 10 times forward EBITDA if you believe that. That's kind of where Facebook is. Do you really think Twitter is going to trade at Facebook multiples? I think the downside is way lower. And I hear both sides. I just kind of think like, hey, I don't think this contract is breaking. I think we're getting a price cut, or we're getting specific performance, to be honest with you. But yeah, I don't know. But it's a really interesting question. And obviously it really affects it, because the odds you're paying if the downside is 30 versus the downside is 20, you're a poker player. You don't need me to tell you. It changes how much, how big of the.
I mean, yeah, I would argue to that guy, like Twitter is what did he say? Twitter's a dumpster fire or something, or Twitter's a mess. That's, for a long time, that's kind of been the opportunity at Twitter, right?
Yeah, I loved when
it might be proving all the margin opportunity that exists.
When Apple changed all the tracking data, and everybody got really messed up because of all the tracking data changing, and all Facebook, Snapchat, all these guys, it eventually really hurt them. And Twitter could just keep coming out and be like, our operations are such a mess, we couldn't use any of the tracking data. It's all upside from here, baby.
Yeah,
I loved it. Last question, put you on the spot.
Sure.
Odds that the deal closes at 54.20, odds that the deal closes at a price cut, nothing crazy, let's say 10 to 15% max, which I think would be huge in the scheme of price cuts. But odds the deal closes with the price cut, and odds the deal just flat out breaks.
I think it's something on the order of, I think there's a decent chance that the board will figure out a way to like do some type of price cut just to like have this be done. So I think it's maybe, but I mean, this case is so strong, it's really hard to get into the mind of the board. And because of all the positive things they've said, like you mentioned, I think it's maybe 60% 54.20, 30% some type of haircut, which I hope would be tiny, and then 10% case, 10% chance of like, something disastrous that somehow the deal breaks and he walks away with only $1 billion.
I think just knowing how much certainty would close for the board, I think it's like 40% close on terms, 55 plus to close with a small price cut. And then I mean, look, One thing people have told me is you never put like less than 5% chance on something happening in the world, because the world is full of right tails. But if you gave me truth serum and I looked at this contract, this is such a good contract. Like, I don't think this breaks for any reason other than Tesla stocks at 100 and he goes to a judge and he gets a finance out, and Twitter throws out the 50-50 shot of, hey, your finance out is off because you blew this deal up yourself, and a judge rejects that. That's how I see this deal breaking, to be honest with you.
Right.
And I think that's a very small chance, but that's how I see the deal breaking. So that would be my odds. Don't hold me to it. I mean, I'm certainly not size like I believe this is 99% to go through, but that's kind of how I see it.
I think you're right. It might be, because I agree. It would optically provide some certainty for the board. I think they would feel better in just knowing this was behind them. And although I can't wrap my mind around like the fact that they already have an ironclad thing. So like a separate, I mean, but you're right. If the money's in escrow, maybe that makes them feel better.
They've got an ironclad thing, but it could get even more ironclad if they could get a contract at 53.20 that said Elon waives everything, right? He waives the bot problem. He puts it all in escrow. So they could get more ironclad, but I'm with you. Last question, and then I will actually let you go. A lot of interesting stuff in the market these days outside of Twitter. Anything interesting our listeners should be thinking about? I should be prepping the third podcast for with you. Anything catching your eye?
Yes, but I am still working on it, so I can't tell you.
I hear you. I put a blog post up the other day. I just think there's so much interesting going on. Like, you know what I haven't had full time to dive into? JetBlue, Spirit, Frontier. I don't know if you're monitoring that, but I've never seen a board so entrenched. That situation is Spirit is selling to Frontier, and the merger price is like $20 at the current price. And JetBlue's out here offering $30 per share in cold hard cash. And the Spirit board is just like, no, absolutely not. Regulatory risk, all this sort of stuff, where their current deal has regulatory risk. JetBlue's offering a massive breakup fee. Like, it's one of the craziest, and that's just one of the many, many crazy situations out there. Markets are scary, but I'm telling you, event-driven is really interesting right now. That's not investing advice. That's just saying it's interesting out there right now.
And it definitely is. I mean, one of the only problems is that, you know, when the market's down this much, is that your current portfolio looks pretty interesting as well. So it's always hard to know where to spend.
You know, Twitter, if it closes, it's 37 to 54. That's going to be the best thing in your portfolio. That's going to be great. But it is true. Like, one thing I've heard from many people who were around in the global financial crisis, which I was in college, so I can't even claim to have really been investing there, was there were a lot of spreads that were trading at 10% spreads in March 2020, which looks great. And they would close in 2 or 3 months, which sounds great. It looks great. But the opportunity cost of buying those versus buying, like, some of these companies were priced for liquidation and stuff and would go up like 4x in a couple months. The opportunity cost was pretty high. And, you know, I would say, hey, markets could have kept going down. Markets didn't have to bounce this hard, you know? So right. I do hear you, but when things start to get this rocky, the opportunity cost of every different asset class and security is the real holdback, I would say.
Yeah, definitely.
Cool. Well, hey, Evan, we've run really long, but that's because this was a lot of fun. It's a great situation. I really appreciate you coming on. I'm looking forward to you trying to catch up to Jeremy Raper with podcast number 3 in the near future. But Evan Tindell, thanks so much for coming on.
Thanks for having me.